Welcome to MarketTamer.com. It is Friday, June 26th, and you're looking at an options chain courtesy of Options Express. Today we'll talk about a strategy that can potentially optimize volatility in the stock market. There are many strategies that can take advantage of volatility, but the one we'll look at is called a straddle, and it's a long-term straddle we'll look at. How do we know it's long-term? Well, we're looking at December 2010 options. They expire in about 539 days. And the symbol we're looking at is SPY. So this is actually a spider. This is representing the S&P 500. And if we take a look at straddle right now, one might be at strike 90 here and would constitute buying the strike 90 long call option at the ask price of $12.25. and also buying the long put option at strike 90 also for $12.25. Now obviously we'll talk in classes much more about how to shave some of that cost off, so you wouldn't actually be paying the full retail price, but that's more a nuance that we'll discuss in classes at MarketTamer.com. For now, just think about the cost of this entire position. $12.25 plus $12.25, so we're looking at a $24.50 cost. Now, as we evaluate the cost, we should always think about what that means for the expected technical movement. And in the case of the S&P 500, it actually suggests that a very substantial movement is needed in the S&P, somewhere in the order of 240 points or so. That being the case, we have to question, is that likely? Could that happen? And probably the best way to figure that out is to look to the past and see, has it happened before? And what's interesting about this is a very, very substantial move that is required in the order of somewhere between 25 and 30%. But if we look to the market movement over the past year, we're only about 6 months in, and we've already seen the market move to that degree twice this year alone. So the question is, could that happen again one time over the next year and a half or so with 539 days to go to expiration? And given the state of the market, given the volatility, given the stimulus package, the expected inflation, and also the weakness in the economy, many would argue that the market is going to go substantially lower based on weakness. Many others will combat that and say inflation will kick in and the market will go substantially higher in nominal terms. And either way, there's a bet on volatility. So one way of simply taking advantage of that expected volatility is this straddle. However, if we were just to enter a straddle, we would absolutely require that movement to make money. And another way of taking advantage of this position is not just to hold these long options, but also to take advantage of short-term premium. And so it is possible to sell options in shorter-term months at various strike prices and various time frames. And we can talk much more about exactly how to do that in classes. But essentially, it's a way of thinking about it might be, certainly if you have a background in real estate, it's almost like taking advantage of a position like a home, owning a home, but also having protection or insurance on it, and at the same time renting out the space month in, month out. And that's what we can do in the stock market. In many respects, not only can we take advantage of a tremendous move up or down, but we can take advantage of stagnation or relative periods of calm. And at this point in time, the market is trapped in a relatively narrow trading range. It has been over the very recent past. Would we expect that to continue indefinitely? Absolutely not. But in the short term, could we take advantage of it? We sure could. And so that's something we can look to a greater extent to bring in income month in, month out in our portfolios when appropriate, while still taking advantage of volatility when it occurs. So if you have any questions on this, feel free to post questions in our forum section. We'll always be pleased to answer those, or simply jump into classes and we'll address them there. Have a wonderful day.